Chapter 1 Preliminary History Jeny Silicon Corporation was a private company based in Batam City, Indonesia and established in 2018. They began produce plastic silicon as a way export to overseas and after learn more about the business. Jeny Silicon Corporation does produce semi-finished goods in the form of acrylic and chemical liquid, taken from material in the form of billboards that have not been used. The company has 20 employees. Mission and objective. We are decided to provide plastic silicone and export to the overseas, so that get your party start to taking care of our 20 employees who know how to find the fun everyday challenge. As a proud member of the Jeny Plastic Silicon Corporation, performance with purpose is that we work to achieve every day. And to us, that meaning creating the high-quality plastic silicone for our customer certification. In our journey to grow, your valuable feedback and attempt are prime driver for us to march on. Company profile. Corporate name, Jeny Plastic Silicon Corporation. Founder, Mr. Tan. Founding date, March 2018. Location, Executive Industrial Park, Block B03, Batam Center, Belian, Kota Batam. Telephone 0778 7490686. Email jenyplastic@gmail.com.
Now I will explain about cost info. Unit to be produced is 203, and then direct material. The material is silicone rubber scrap. Size per unit is 10. Price per unit is 380,000, and then direct material cost is from unit produced times size per unit times price per unit. So the direct material cost total is 771,400,000, and then direct labor, the labor is 203. Direct labor hour total is 1. Price per hour for one worker is 20,000, and then total direct labor hour cost is from labor times direct labor hour total times price per hour for one worker. So the total direct labor hour cost is 4,060,000, and then the last is overhead. The activity is machining, cutting, melting, cooking, and packaging. And then activity driver for machining is machine hour, cutting is cutting hour, melting is melting hour, cooking is cooking hour, and packaging is of unit. And then total driver for machine hour is 10, cutting hour is 14, melting hours is 22, cooking hours is 13, and then packaging of unit is 15. And then the fixed cost for machining is 15 million, and then cutting is 18 million, melting is 10 million, and then cooking is 9 million, and last packaging is 8 million. And then the variable cost is 107,200, and then for cutting is 142,000, and for melting is 177,000, and cooking is 142,000, and then packaging is 90,000. And then the total fixed cost is from here, and then total variable is from variable cost times total driver, and then the total cost is from total fixed cost plus total variable cost, and then the total is 60,150,000, and per unit is 269,305.42. And then for the pricing policy is markup 50%. The unit to be produced is 203, and then unit selling price for direct material is from here 771,400,000, and then direct labor is from here 4,060,000, and then overhead costing is from here total. After that, the total production is from direct material plus direct labor plus overhead. And then for calculate the unit production cost is total production divide unit, and then after that we use this to calculate the unit selling price is from unit production cost plus unit production cost times 50%, and then for the revenue sold is from the revenue sold is from unit selling price times unit sold. So the total is 1,253,415,000.
Activity-based management for Jeny Plastic Silicon Corporation. Activity-based management have 5 activities. Machining activity driver, machine hours. Coating activity driver is cutting hours. Melting activity driver is melting hours. Cooking activity driver is cooking hours. Packaging activity driver is op unit. Standard quality of machine hours is 8 times. Actual quantity is 9. Actual usage is 10. Then standard price is from cost import. Next is activity value add, non-value add, and actual cost. Value add is from standard quantity twice standard price. Then non-value add is from standard quantity less actual quantity twice standard price. Yeah, actual cost is from value plus non-value. Quality cost report of Jeny Plastic Silicon Corporation. Quality cost for Jeny Plastic Silicon Corporation for the first is preparation cost include quality training. Then the percentage is 2.46%, and the budgeting is 2.5%. Operational costs include inspection of material, product expenses. Percentage is 0.65%, and the budgeting percent is 0.69%. Product acceptance, the percentage of actual is 0.88. Product acceptance budgeting percent is 0.98%. Then internal value cost include reward. Actual percent is 2.76%. Then budgeting percent is 3.33%. Repairs actual percent is 2%. Budgeting percent is 2.36%. Reinspection actual percent is 2.09%. Then budgeting percent is 2.63%. External value cost include complaint adjustment. Actual percent is 1.80%. Budgeting percent is 1.95%.
After that, we calculate the budgeting. For the first, we calculate the sales budget. The sales budget is from the sales unit times the unit price. So we can find the sales budget. The next, we calculate the production budget. To calculate the production budget is our sales unit add on the desired ending finished good. So we find the total net. After that, we less on our beginning finished good, so we can find the unit to be produced. After that, we calculate the direct material purchase budget. The direct material purchase budget is from unit to be produced times the direct material per unit. So we find the result is production net. After that, we add on our desired ending raw material. So this is our total net. After that, we less on our beginning raw materials. So the raw materials to be produced, we times the unit price. So the result is raw material purchase budget is this. After that, we calculate the direct labor budget. Direct labor budget is from unit to be produced times the direct labor hour per unit. So we can find the total direct labor hour needs. After that, we times the direct labor hour less. So we can find the total direct labor hour budget. After that, we calculate our overhead budget. Overhead budget is from production variable overhead cost add on the production fixed overhead cost. So we can find our total overhead budget. The next, we calculate the selling and administrative expense budget. Selling and administrative expense budget is from our total variable selling and administrative expense add on the total fixed selling and administrative expense. So we can the result is total selling and administrative expense budget. After that, we calculate our ending finished good inventory budget. After that is cost of goods sold budget. Cost of goods sold budget is from our budgeting manufacturing costs, which are from direct material use plus direct labor hour use plus overhead. So this is our budgeting manufacturing cost. After we find the budgeting manufacturing cost, we add on our beginning finished good, so we can find our good available for sale. After that, we less our ending finished good, so we can find out our budgeted cost of goods sold. After cost of goods sold, we calculate the budgeted income statement. The budgeted income statement is from our sales less for the cost of goods sold, which we already calculate in this. After that, we can find after the sales less the cost of goods sold, the result is gross profit. After gross profit, we less our selling and administrative expense, and we can find our net income. After that, we also do our cash budget for April 2019. After budgeting, we do the actual. For the actual, the calculation method is same with the budgeting method. After we calculate the budgeting and actual, we can know that have difference between actual and budgeting. We can find out the and for the actual, we also need to find actual sale, actual production, actual direct material purchase, actual direct labor, actual overhead, actual selling and maintenance expense, actual and finished good, actual cost of goods sold, actual income statement, and actual cash budget. The calculation method is same with the previous budgeting. And after we calculate this, we can find out our cost of goods sold of the actual is higher than our budgeting cost of goods sold. Yes, this is higher than the actual. And as for the budgeting income is also higher, the actual is also higher than the budgeting. After that, we do variance analysis. Variance analysis is to calculate the difference between budgeting and actual. So after we do the variance analysis, we can find out the unit to be produced. Following variance, the result is favorable, and the direct material is unfavorable, direct labor also unfavorable, fixed overhead, variable overhead, cost of goods sold, gross profit, selling and administrative expense is unfavorable, and as for the net profit is favorable. After that, we do the journal. At 1 April 2019, purchase material in cash. The journal is purchased to cash. At 3 April 2019, sales on cash for 50 units of plastic silicone with its selling price is 21 million. The journal is cash to sales and sales to inventory. At 4 April 2019, purchase office supplies in cash. The journal is purchase office supplies to cash. At 10 April 2019, purchase material in cash is the journal is purchased to cash. Next, at 50 April 2019, paid miscellaneous expense for 2 million. The journal is miscellaneous expense to cash. At 70 April, sales export to China on cash for 100 units of plastic silicone to Yanzhou, Hongyuan, with its selling price is 21 million and charge shipping expense for 4,005,000. The shipping expense is paid by supplier. The journal is cash to sales, shipping expense to cash, and cost of goods sold to inventory. At 18 April 2019, purchase material in cash. The journal is purchased to cash. Next, at 19 April 2019, purchase 2 machines in cash. The journal is purchase machine to cash. Next, 20 April 2019, sales on cash for 83 units of plastic silicone with selling price is 21 million. The journal is cash to sales and the cost of goods sold to inventory. Next, at 22 April 2019, paid labor cost. The journal is direct labor cost to cash. At 25 April 2019, paid overhead cost. The journal is overhead control to cash. Next, at 30 April 2019, paid wages salary to 20 employees. The journal is wages expense to cash. Next, at 30 April 2019, because of shortage of cash, so borrow with the bank. The journal is cash to bank loan. Next, at 30 April 2019, because pay utility expense for 300,000. The journal is utilities expense to cash. Next, tax office supplies expense. The journal is office supplies expense to cash. Next, paid telephone expense is telephone expense to cash. And paid other expense for the journal is miscellaneous expense to cash. Next, we calculate the inventory. The beginning inventory is 30 units, and then total products is 203. We add the beginning inventory and total products. The total is 233. And then we less the sale. At 3 April we sell 50 units, so we less the 50 and sell 100 units, less 100 and less 83 units, so the ending inventory is 0. Next we do the statement. First is statement of financial position. The current asset is cash, at inventory, at office supplies, at machine, and the total asset. And current liabilities was payable, the total current liabilities. Next, equity capital, the total equity. So the total liabilities and equity asset is and liabilities at equity. Next, we calculate the statement of financial performance. Sales less the cost of goods sold. We calculate the gross profit. And operating expense, utilities expense, at office supply expense, at salary expense, and telephone expense. So the total operating expense, and also have other expense, miscellaneous expense, at shipping expense, and the total other expense. So the total expense is total operating expense at other expense, operating income, and the net income. Next, we do the statement of financial performance, variable costing. Sales less the cost of goods sold, gross profit, operating expense, have fixed factory overhead, at utilities expense, at office supply expense, at salary expense, and at telephone expense. So the total operating expense and other expense have miscellaneous expense at shipping expense. So the total other expense is this. So the total expense is total operating expense at total other expense, and the operating income is and we calculate the income statement. The sales is and then less cost of goods sold and gross profit, and then we less selling and admin expense, and we get the result net income.
Chapter 4 Analysis. The financial statements in Plastic Silicon Corporation period April 2019 can be said is good. When viewed from income statement, the performance of the company shows a profit situation. The company also controls costs well, so that the cost incurred is fair and reasonable. For startups, Jeny Plastic Silicon Corporation shows a good performance. From the company statement of financial position in April 2019 period, Jeny Plastic Silicon Corporation shows that the company can operate with the company capital. The financial statements in Plastic Silicon Corporation period performance show that the state of the difference in profit April 2019 is much better. When viewed from income statement, the company gross profit 253,305,000. In this project, the difference between sales budget and actual budget is 693 million. And as for the difference between budgeting income statement and actual income statement is 33,022,600. Chapter 5 Conclusion. Jeny Plastic Silicon Corporation manufacturing silicon and export raw material to China. Third transaction in Jeny Plastic Silicon Corporation starts when customer place order for quantity they need, and we produce material as much as they order. Some internal control that have already applied in the company is good enough. And after we analyze the revenue cycle, we found some improvement in the cycle in Jeny Plastic Silicon Corporation. For example, for overall selling quantity is higher than the budget.